Want to know the single most important concept in trading? Understanding candlesticks got me from struggling and second guessing myself to complete clarity on the charts. The framework you're about to learn was for me the complete foundation to becoming profitable and getting consistent payouts. And in this video, I'm going to give you the only framework you need to master candlesticks. This video is for beginner traders, but also for experienced traders. To do this, first I will go over how to read candlesticks. Then I'm going to walk you through how to trade them and what patterns are best to use. And with this foundation, I will also give you a plug and play entry model based on only being able to read candlesticks. So let's get into it.
When you start trading, one of the first things you see on a trader screen in general, it looks something like this. You see a window with lots of lines, colors, and just a whole bunch of stuff you don't understand yet. Today, with candlesticks, we're going to talk about the figures right here. You see up, down, and all these single parts are called candlesticks. A red candlestick, a green candlestick, a red candlestick is down, green candlestick is up, and the market, and every single second, every single hour, every single day, a new candlestick is printed on the chart. So in this episode, first we're going to discuss how to read candlesticks. Then we're going over how to trade them. We're going to the charts to see some actual examples and give you some rules. And then we're going over some basic patterns and some more intermediate level patterns to further develop your understanding. And at the end, I will give you a nice entry model so you can already start looking. You can already start seeing some trades on the chart yourself. How to read candlesticks. In this first example, we're looking at a bullish candlestick. A bullish candlestick is most of the time a green one. And there are a few things you should know about the candle. First of all, this green box is called the body of the candle. These small lines up and down are called wicks of the candle. In an up-close candle, price will open here. So this is the starting price of this candle. Then price will go lower, creating the wick. Price is opening here, then goes lower, creating the wick. Then it goes upwards, price, creating the body of the candle. And then when price here, it goes a little bit down, creating the closing price. So here, it's open. Then we create the low of this candle right here. Then we're going all the way up, bring the high of the candle, then we close. So the candle looks like this, but on the chart in a line, it looks like open, low, high, close. The body, wicks, open, low, high, close. This is what you should remember of candlesticks. This is the only thing you should remember about how a candlestick looks like. Same for a bearish candle, a down candle. Most of the time, those are red on the charts. You can give them different colors, but by default, green is up, red is down. A bearish candle starts here, open. Then it trades higher, create a high of the candle. So the body starts here, then the wick, high of the candle. Then it trades all the way down, saying the low of the candle. And then we have to close. The difference between a bullish candle, a green one, and a bearish candle, a down one, is that the open of a bearish candle is up here. And the open of a bullish candle is down here. Open, low, high, close. And a bearish candle is open, high, low, close. It's the other way around. Now let's go a little deeper into this. You just saw a nice balanced candle right here. Body, the wicks are kind of the same length. But what if you see this on the chart? So remember, this is the open. Then we go all the way down here, saying the low of the candle. Then we trade all the way up here, saying the high of the candle, and then the close. What does this say about what price is doing? In this example, we have lots of buy pressure. Why? Price starts here. it goes all the way down here, saying the low of the candle. But then, in the same candle, it trades all the way back up here. And then closing right here. That means we had some sell-off here, going lower, but this candle shows lots of buying pressure. And it means, if you see this candle, you can predict that most likely the next candle is going to be a green one. Because we had so much buy pressure, you can expect the next candle to be green as well, to go higher. There's a name for this candle, and it's called a bullish hammer. There's no need to remember names of candles. You just need to understand if a candle looks like this, then on the chart, the price action is like this. So open, low, high, close. With lots of buy pressure. And vice versa for a bearish candle. Opening price, we go all the way up. At the same candle, we go all the way back down. Creating the low of the candle here. So here, lots of sell pressure. So that means the next candle is most likely going to be a red one. Lower prices are ahead. And this is called a bearish hammer. So now you know what a normal candlestick looks like, a bearish and a bullish one. You know how a hammer looks like with lots of buy and sell pressure. But what if a candle doesn't have a wick or a really small one? What does that say about a candle? If you have a green candle with no wick, so that means price opened here and without going lower, it just went straight up. That means we are very bullish. The same for a red candle with no wick. We opened here and we didn't go higher. We just go boom, straight down. So that means a candle without a wick is, if it's the green one, it's very bullish. If it's the red one, it's very bearish. So with the green one, there's lots of buy pressure, pushing price higher. If you see this on a red candle with no wick, there's lots of sell pressure. It's a very bearish sign. Let's continue with what we just learned. Here you see a red candle, so price is going down. Then we reach an important level. And an important level, for example, can be an old low, an old monthly low. So for example, it's now July, and we reach the lowest point of the month of June. If you see on an important level, the price trades lower, lower, lower. When reaching this point, what does this candle do? Open, low, high, close. Because we reached this important level, but what we did is we didn't go lower. We reached the important level, but there's no body here. There's a name for this. We're going over that in a second. But if you see this happening on an important level, you can expect the next candle to be green. You need to follow the momentum. If this red candle was followed by another big red candle at this important level, you can expect the trend to just go down, down, and down. But what we did, we reached the important level, and then we saw higher prices. This was no red candle going lower. This was a green candle. It's indicating a reversal. Then you can expect the next candle to be green. So very important, follow the momentum. Same on the other side. So for example, you reach a important level, a old high. So price here, open, low, high, close. So in this candle, we are going towards the important level. And then this candle, we open here. The high of the candle. And the low of the candle, and we close here. What does this say about price? Follow the momentum. We are at an important level. We don't close over this because the close of the candle is down here. It's also indicating a reversal towards lower prices. Open, high, low, close. Every time you see a candlestick, try to figure out how the actual price is moving there. If you would have drawn a line. To repeat here. Open of the candle. Here, we're going lower. Then going to the high of the candle, the high of this wick. And then we close here. It's the framework of a bullish candle. Then the framework of a bearish candle is the open is not at the bottom of the candle, but at the top of the candle. So here. Right here. Open. High. Reaching an important level. We are reacting from this level. Take the low of the candle. And then we close here in this candle. So the next candle opens here. Open. High. It's wick. Goes all the way down. Low. Low of the candle right here. And then it closes right here. And again, follow the momentum. So here we reach an important level. We fail to close under it. The close of the candle is right here. So then you can expect higher prices. Vice versa. Reach an important level. We fail to close above it. And then you can expect lower prices. A little extra to this framework is compare the size of the candle with the wick. The bigger the body compared to the wick, there are more momentum and volume in the candle. So let's draw this out again. We open here. High, low, close. And we open this candle. Open, low, high, close. Open here. Open, low, high. You see the momentum in this candle. Boom. Higher prices. And on a line, it's maybe very easy to see. But you need to learn how candlesticks look like. How the candlesticks look exactly the same. How candlesticks show exactly the same as a line chart. So the bigger the body compared to the wick, the more momentum is in price. If you see this happening on your chart, we have a red candle going down, probably here, important level, somewhere here. You see price reacting and then having a big volume higher. Well, my money would be on that the next candle is going to be higher again. And how would that look like? We have an open. We have a low of the candle. We have the high of the candle, and then we close. So this is of course this color is red, but it needs to be a green candle.
Hey, so it's finally the end of the video. And great that you made it to the end, and I hope you got some value. Click here on this video because YouTube thinks that you might be interested in seeing this one as well. And do not forget to leave a like, subscribe.